LLCs. So here I want to walk you through what happens when you set up an LLC and go to do your taxes. Now I use $100,000 of revenue and $25,000 of expenses like the other examples, so we have an apples to apples comparison. So this right here, this 16,677, ultimately that's going to be the balance due, assuming an LLC, and again, an apples to apples comparison to the other types of business entities that we'll discuss. So let's jump into it. So first and foremost, in order to look at what happens with strictly the business of the LLC, we start up with what is called the Schedule C. And you'll see that right here. The Schedule C has the owner's name, so again, Sam Smith, his social security number, but we also have right here the actual name of the LLC. So in this case, we call it Sam Smith Consulting LLC. And then right here on the Schedule C, you'll see his employer ID number, which he gets from the IRS when he sets that up. So that shows, again, he's got the LLC set up with the IRS. It still is related to his personal return, but this is the basic information that we're going to have on that LLC. And then we go through it. So right here, it shows that he did have the $100,000 worth of revenue for the business for 2020. And then right here, it's going to show that he had $25,000 worth of expenses related to the business. And again, we kept it very simple, very basic. If it was a more detailed return, we're going to fill in the advertising, if he had car and truck expenses, if he had insurance, if he had a mortgage on the property that he was operating out of, if he had legal and professional fees, if he had rent instead of a mortgage, if he was renting any machinery or any equipment, if he had any repairs, supplies, wages that he paid anyone. But again, we just want to keep it simple, keep it plain, have the $25,000 worth of expenses. So what we do with that is we say, okay, he had $100,000 worth of revenue, then he had $25,000 worth of expenses. So that gives a profit of $75,000, and that's for the business. So that's what, again, Sam Smith Consulting LLC did for the year related to the business. So how does that relate to the personal return? Well, this is where it starts. So if you look at line number 31, that $75,000 on line number 29 drops down to line number 31. And as you see, it relates to Schedule 1. And that Schedule 1 is the beginning of the personal tax return. And then you see it right here on line number 3. That again is that business income directly related to Sam Smith Consulting LLC. Now, like I said, we're not going to account for any other income here. We're not going to look at, any alimony he may receive, if there was any rental property, if he has a farm, if he had unemployment. Again, we want to keep it simple, keep it basic, keep it plain, have that $75,000 show up on the personal return. Like I said, this is the first place that it shows up on the Schedule 1, but then it's going to show up on the main return. And what I mean by the main return is this Form 1040 with the IRS. This is the form that everyone knows as the personal return, and this shows the direct connection between the business and the personal and that flow through. So again, we're starting up with Sam Smith. We've got his social security number. We've got his home address. He does not have any dependents. Again, we're assuming that he's filing single and he's not married filing jointly or married filing separately. He doesn't have any dependents and he's not a widower. And then when we look at the details, we're looking at the different lines on the return, again, for the personal return. We're saying he did not work a regular 9-to-5 job where he got a W-2. He did not have any interest on any savings accounts. There were no investment accounts that had any dividends, no IRA distributions. He did not have any pensions, no Social Security, and no investment accounts that had any capital gains or losses that we're going to account for. So again, we're working with that $75,000 right here on line number 8 and line number 9. So what do we do next? So what we do next is we go to line number 10A. And what is 10A? Well, that goes actually back to that Schedule 1 form that we discussed earlier. And what that is specifically is the deductible part of the self-employment tax. So this is going to be critical when you're looking at the entities that you want to set up. When it comes to LLC, very similar to sole proprietorship, there is this self-employment tax that is deductible, but it also has to be paid, and we'll get to that in a little bit later. But unlike an S corporation or a partnership, there is no self-employment calculation. So that's one of the major differences that you see. But again, this shows you right here what the deductible part of that self-employment tax deduction is. So how do we figure that out? Well, there's what's called a Schedule SE. And what that Schedule SE looks like is this. So what we do is we take that $75,000 that we had initially of that profit for the business, and then we're going to multiply it by 92.35%. And then we're going to run it through the formula. And when we run it through the formula, that's how we're going to eventually get to this $10,598. And we'll discuss this a little bit, how we got to that. But again, half of that is this $52.99, which again goes back to the part that is deductible when it comes to the tax return, and that's right here. So that deductible part says, okay, we're going to have that $75,000. We're going to subtract out this $5,299 because we can take that as a deduction. And when we do that, that's how we get to the $69,701 number. And that becomes the adjusted gross income on the personal return for Sam Smith. Now, the next line, what this is the better of two deductions that he can take. It's the standard deduction or the itemized deduction. And in this case, it's more advantageous for Sam to take the standard deduction. There's a long conversation we can have between looking at the standard deduction and the itemized deduction. But again, for simplicity's sake, we're going to use the standard deduction. And as you'll see right here, it's the $12,400. If he was married filing jointly, it would be $24,800. If he was a head of a household, it would be $18,650. And a head of household means, he claims a child or he claims a parent or another individual that he's taking care of. But again, we're just going to keep it simple, keep it plain, say that he is single, just like the other examples, and he's going to take that deduction of this $12,400. Now, the next deduction that he's going to take is the qualified business income deduction. And that is a deduction that as a business owner, he's entitled to. And the way that's going to look is right here. So what we're going to do is we're going to take that $69,000. Then we're going to that standard deduction we talked about before of that $12,400. When we do that, we end up with the result of this $57,301. So again, we're taking the $69,701, subtracting out the standard deduction of $12,400 to yield this $57,301. And then again, this is just the formula that the IRS has. Then what we do is we take that $57,301, multiply that by 20%, and that's how we get the standard deduction. I'm sorry, not the standard deduction, but the qualified business income deduction of this $11,460. That's the calculation, how that's determined. And again, getting back to the major return, it's going to show up right here. Now, what do we do next? So we take that standard deduction of this $12,400, we add it with this $11,460 for the qualified business income deduction, and that's how we arrive at this $23,860 number right here. So big picture, what we do is we now take that $23,860, we subtract it from the $69,701, and that's how we arrive at the $45,841. Big picture, what does that mean? Sam Smith, with his consulting business, had $75,000 worth of profit, but once you factor in his deductions, he is only taxed, and again, taxable income, on $45,841. So that's how we get to that calculation. So what do we do with that $45,841 number? Well, we turn to page 8 of 25 on the IRS 2020 tax table, and we say, okay, he made $45,000 worth of taxable income. The initial tax that they want him to pay on that is this $58.72. And again, you'll see that on page 8 of 25 on IRS tax table for 2020. There's no adjustments here, so nothing to calculate for line 17. Same with line number 19, line number 20, nothing to adjust there. And that's why we have that 0 on line number 21. And then line number 22, again, reflects that initial tax of this $58.72 that the IRS initially wanted him to pay. Now, line number 23, what that is, and it's very similar to the sole proprietorship, but very different than the S corporation or the partnerships, where you now have to factor in that self-employment tax. So what does that self-employment tax look like? Well, let's run through the calculations. So what we do is we take the $75,000, we're going to multiply that by 92.35%, and that's how we arrive at that $69,263. Then what we do is we take that $69,263 and we're going to multiply it by 12.4%. And what that is, that's that 8589 number. That is the Social Security tax that Sam Smith is responsible for. We also take that $69,263, multiply it by 2.9%, and that's how we arrive at that $2,009, and that's the Medicare tax. When we add those two together, that's how we get to the $10,598. And again, what that is if you compare it to a W-2 with a regular employee wage, you're going to see in box number 4 and box number 6 that taxes are taken out to pay for Medicare, to pay for Social Security for that person. If you're self-employed, have an LLC, this is where it's going to show up right there. So that, again, $10,598 is the ultimate number we're going to use right there. And the way that's going to show up on the main return is right here. This is where we've got that $10,598. We take that $10,598, add it with the $58.72, and that's how we arrive at the total tax that he has for the year of $16,470. Now, there's no other adjustments here. However, what is also being factored in here is this 201 right here. And what that says is during the year, Sam Smith Consulting LLC should have paid estimated taxes throughout the year. Because he did not do that, there's a penalty of $207. We add that with that $16,470, and that's how we arrive at him owing the $16,677.